Nothing boring about our guest today. Nick Foley, Senior Municipal Opportunities Portfolio Manager for Siegel, Bryant & Hamel, join us today. Nick, congratulations on a successful 5 years managing the strategy. Take us back. Where did the interest in municipal bonds and becoming a portfolio manager come from?
So when I started out in fixed income, I was more of a generalist. So I traded corporate bonds, mortgage-backed securities, asset-backed securities, treasuries, and then the asset class no one wanted to trade was municipal bonds. And as I worked across all those, I started to realize and really feel that the area I could add the most value in was actually municipal bonds. So I started delving a little bit deeper and deeper into the market, and the further I went down that rabbit hole, the more and more fascinated I became with it. And so at that point, I realized I'd found what I wanted to do with my career, and I wanted to find a full-time role where I could focus 100% of my time on it, and that's how I ended up at Siegel Bryant.
So why did you start this particular strategy?
We had been managing municipal bonds for about 30 years. We'd been running a mutual fund, but as we looked out at basically all the options that were available to investors, we realized pretty quickly that it felt like there was something missing. There hadn't really been a whole lot of progressive thinking and new strategies, new ways to go about things. It just seemed as though conventional had somewhat worked over the last 30 years. And so everyone was just sticking with that. And as we looked at that, we became pretty convinced that there was probably a better way to go about things. And so that was really the genesis, is just starting with a blank page and saying, starting day one, what is the best way to allocate capital in this market? Is there a better way? And we became very convinced there is a better way. And so 5 years later, we feel very happy and proud of how that's worked out.
Reflecting back as manager of the portfolio, how have you seen the muni market change, or what has surprised you most?
The thing that's the most surprising is actually that not a whole lot has changed. We've seen these massive innovations across other fixed income asset classes, corporate bonds, equities certainly, and meanwhile the municipal market has stayed very much the same. If anything, a lot of the issues we've seen in the municipal market 5 years ago have actually even gotten worse, to the extent that we actually think that some of the inefficiencies that we take advantage of are actually getting better for us. So,
what do investors need to know, or what are some misconceptions around the municipal market?
Yeah, misconceptions are similar to my initial introduction to munis, is that it's just a boring market where not a lot happens and it's sleepy, and and from that, what I would say is, and what our conviction is that it is actually one of the most complex fixed income markets that exists out there. As we look at the structural nature of the market, the amount of optionality in the market, how that optionality is priced, the sheer number of issuers, we feel we can prove with a pretty high degree of conviction that it's actually one of the most complex markets that exists.
So how do these misconceptions play into the opportunities that you see?
Yeah, absolutely. It plays in perfectly in the sense that essentially if you have an investor base that's out there saying, we don't need to spend a whole lot of time looking at this market, we don't need to do a whole lot of work in this market, we don't need to dig deeper, that's exactly where you want to be if you're an institutional investor, right? The deeper and darker the hole is that no one wants to go into, that's usually where the best opportunities are. And so from that standpoint, that's what allows us to do what we're able to do, is that if you're willing to do a lot of the work, a lot of the grunt work, information is not readily available in the market, so you have to work increasingly hard to find any small bit of data that's out there that can help you with a certain issuer or with what's going on in the market. But as you find those things, the value you can create from them is exponential in our minds. So,
14 years in the business. Today, what concerns you most?
yeah. What concerns me the most by far is what we've seen in the high yield market over the last, I would say, about decade. So we've seen this massive growth in the underlying high yield market, and we've seen a massive amount of flows into the high yield market, which is justified as the asset class has done very well. But what's happening and what people don't see is that as more and more money flows into that market, there's more money than there is bonds in that market. And so what happens is that issuers are able to get away with doing worse and worse covenants, which are the things that protect bond investors if something goes wrong. And essentially pricing has gotten so aggressive that you're really not even paid for even a very small incremental amount of risk. And so our fear is that the sheer volume of flows that have gone into high yield strategies is at some point going to reverse. And when it does reverse, the question has to be asked of who's going to be that incremental buyer when things get bad. And our view is that, again, for a shopping mall in New Jersey that's non-rated, the buyer, incremental buyer, that is likely not going to be asking for a couple points down to buy that bond. They're going to be asking, or they're only going to be willing to pay for just cents on the dollar. And so that's really what concerns us the most. We don't think it's a question of if, it's more of just a question of when.
So the muni market's a crowded space.
Yep.
A lot of managers, a lot of strategies, a lot of big brand name firms.
Yeah.
What separates you from everybody else? What's your hook?
Our hook is that we just think about things a little bit differently, I guess is the easiest way to put it. We look at the market from a not necessarily how is the benchmark allocated per state, right? So we step back and we look at the benchmark, and 33% of the entire benchmark's in California and New York, right? Well, those are the two highest income tax states as well. And so people in those states are willing to pay up to own bonds in those states. We step back and we say, not just, well, the index owns 33% California and New York, we should go buy 33% in California and New York. We're looking out across every single investment that exists in this very unique scattered market, and what we think is the most misrated bonds, the most mispriced bonds, many times agnostic of, again, maybe we have a little bit higher concentration in this state or in this sector, but we want to go out and allocate capital where we think it's the most effective, not just trying to track a index that essentially we think is not the correct way to be allocating capital anyway in the municipal market.
So we've spent this time looking at the past 5 years. What can we expect 5 years from now?
Sure. It's been a fascinating time over the last year alone for the municipal market. So obviously COVID, and then we had the subsequent fiscal packages that came out. The last fiscal package was directly targeted, obviously, at state and local issuers of municipal bonds, and they received a pretty substantial amount of funding. But I think one of the things that really gets missed is that in all the previous packages, a lot of that money actually went to municipal issuers. So if you think about it, airports, hospitals, mass transit, in each one of those bills, there were very large packages going to all of those issuers. And so when we add it all up, we're looking at somewhere around $1.1 trillion has actually flown to municipal-centric issuers, is what we would call it. Now, that being said, as we reflect back during the last year, the last 18 months, what we see is that municipal issuers actually did not fare as bad as most people thought they might. They've actually fared quite well. And so as we think about that, and what we're seeing now is that the balance sheets of municipal-centric credits have been bolstered fairly dramatically. And so credit, I would say, is probably one of the best, strongest points I've seen in my career. And so it'll be interesting to see kind of how that plays out over the next 5 years. I always joke that the best tailwind in the world for any asset classes is higher tax rates, which directly affects municipal bonds. So anytime taxes go up, either at a state, city, or at the federal level, even 1%, right? That makes every dollar of your tax exempt income worth just a little bit more. So it should be a good next 5 years for the municipal bond market, and we're excited to be a part of it.
Anything but a boring asset class.
Yeah, anything but.
Nick Foley, thanks for joining us.